Thank you everybody for joining. My name is Geoff Green. I'm going to be your host today for the June 2022 housing market update. We are definitely in a time of transition with the housing market, the mortgage market, so on and so forth. There's a lot to talk about today. We have some really great panelists to guide us through. But before we get to the panel, let's get right into the slide deck here so we can see what's really going on. All right, so we're going to check in with the panel. There's a sneak peek at who we have, but let's get right to the numbers and the discussion points. So it really is all about mortgage rates right now. In my personal opinion, I think that's the major thing that's causing a transition. But of course, many things go into mortgage rates. And we have this inflationary period that we're in right now, which is serious and it's real and it's happening right before our eyes. We've been talking about inflation for over a decade, and it's here. So what's positive about what's happening with the mortgage rate environment is that it kind of has plateaued a little bit here since mid-April. Rates were on a drastic rise up until April, and they've somewhat flattened out. Now, we're going to talk with our friends today from AnnieMac who are on the panel about where they see rates kind of heading through the balance of 22. But for right now, things have kind of stabilized a little bit. In comparison to where we were in previous decades, I mean, yes, obviously right now it's significantly higher than it was 6 months ago. But where are we historically? Well, you can see in the 70s, the average rate was 8.86. In the 80s, it was 12.7, 90s, 8.1, 2000, 6.25. And this is where I started out as a first-time home buyer, was 6.5% interest rate. And it was an okay rate at the time. It wasn't great. It wasn't bad. And then at the, after I bought my first home, I think that was back in 2003 or 4, rates were kind of on the march downward after that point in time. So we've had a good run, but really where we're at right now, 5, encroaching on 6 is historically just not a terrible rate. So I think it's certainly a shock factor for anybody that hasn't received this information yet and doesn't have historical perspective. We were at 3 something and now we're at, approaching 6. That's a 100% increase. But historically, it's not such a bad deal. The other thing that's important to note is that, this chart says here, for almost 50 years, the 30-year mortgage rate has moved in unison with the 10-year treasury yield, and that still continues. And we're seeing a little bit of a convergence on the variance here. As you can see, the blue line's headed up and the green's headed down. So maybe we'll see the two crossing over. But the point is that this is nothing necessarily out of whack historically. Things are kind of in check. So are we in a correction? Well, the definition of a correction is a decline of 10% or greater in the price of a security, asset, or financial market. Okay, that's the definition from Investopedia. And we're certainly not seeing that, because the bottom line is we're still seeing home price appreciation. So what we've been talking about here in the housing market update for some time is just deceleration. It's, in other words, the rate at which prices are increasing is decelerating, but home price has not yet declined. So we are at a turning point. I think this is a really good quote from Chief Economist Danielle Hale at Realtor.com. The housing market is at a turning point. We're starting to see signs of a new direction, but the ball is still in seller's court in most housing markets. Okay, and that is true. And we're going to hear from 2 very active realtors on the ground to see, are things loosening up? Are you seeing price reductions? Are you seeing less buyers come to homes? And I think the answer is going to be no in some of those cases. So the real price house index maintained by First American Financial Corp rose by 32.5% year over year in March, marking the largest annualized jump for this metric since it was established in more than 30 years. So to say that prices are on the decline and things are going to, drastically decrease, I think is just something that you're not really looking at the facts, because price is still very much being determined by supply and demand. And there still is just not enough supply right now for buyers who are looking to buy. So we are seeing, maybe a little bit of a softening in the number of showings. But again, still, if you look back all the way to 2019, pre-pandemic, which was, by the way, a very robust, good real estate market. And then the pandemic hit and everything just literally went to a new level. But still, as we were looking back on April numbers, the number of showings is just, even outpaced, April from 2020, not from 21. If you look at 21's April number, it's 281 versus 251. So it is slowing down a little bit, but historically, and even looking back at that previous year of 2019, which again was a strong year, not much difference. And this chart shows the same. This is an annually adjusted home sales by the NAR, the National Association of Realtors. And while you see a major decrease in their projection for 22 versus 21, it's still a very solid year. I mean, 2020 was an amazing year. 21 was just in the stratosphere. And now we're just back to an amazing year of 5.6 million in 2020. And again, you can go back to 2019 and see those were significantly lower. And those were great years. Those were very solid years. So, it doesn't seem to me at this point that we're talking about a bursting of a bubble. I think we're just seeing deceleration, which honestly is a good thing. We all could use it. Buyers, sellers, agents, everybody involved in this process. It's been insane for the last couple of years. So the average days on market right now in April of 22 is 17 days. That is a very low number. That means that homes are only staying on the market for an average of 17 days. And that's the nation as a whole. You can see where, we are in this particular area. It's right in that range, right? It's 15 to 30 in that particular range. So, the darker the blue, the hotter the market. So, and then offers, 5.5 offers per home on average across the country is pretty solid. You're only seeing one state in the union in Wyoming with an average of one offer per listing. So it's still it's a red hot market. So what's ahead? Well, mortgage rates, according to Mike Fratantoni, chief economist of the MBA, who our guests from AnnieMac know well, I'm sure. This is a good quote from him. So let's read it. Mortgage rates are likely to plateau near current levels. We saw evidence of that in the first slide. Okay. The financial markets have attempted to price in the impact of Fed actions over this cycle. What that means is you've all seen the stock market, the Dow or the S&P 500, you've seen it come down. The Dow is flirting with under 30 at this point. So there's been a substantial decrease, and a lot of that has been inflationary pressure, right? So the markets have corrected, the financial markets, and they're likely also pricing in the economic slowdown that will result, right? So once we are past this rate spike and associated volatility, MBA expects that potential home buyers may be more willing to re-enter the market, which is a really good point, right? And the point is, when it's turbulent, maybe I'm motivated to get in now because I'm not sure if rates are going to continue to go up, or maybe I don't want to get in because it's so crazy. I just don't want to, participate in such an unstable situation. So I think as things start to stable and we realize what our new reality is, people will get more comfortable and buyers will continue to enter the marketplace. I'm going to skip over this one just for the sake of time. I'm running a little bit long here, but there are so many good quotes that are relevant. So Realtor.com, experts don't believe the market is in a bubble or a crash is in the cards, like during the Great Recession being from 2008 until 12, 13, somewhere around there. The nation is still suffering from a housing shortage, right? That has reached crisis proportions. That is true at a time when many millennials, which is true, the largest population right now are the millennials, are reaching the age when they start to consider home ownership. So what this is saying in essence is that there are real supply and demand issues at play here. This is not a situation back in 2003, 4, 5, 6, 7, where there was just an abundance of loan offerings and bad loans being written and not enough, and already too much inventory. This is legitimate supply and demand. So until the supply increases or the demand decreases, we're just not going to see a major decline in price. It's just not going to happen. So let's talk about recession, and the definition of it. It's a significant decline because you're starting to hear a lot about recessions, and we may very well slide into a recession. I think it's likely that we will. if you ask me, I say, yes, we may already be in a recession. And if not, we're heading there. It has to be, right? In a free market system, recessions are just part of the deal. So it's a significant decline in economic activity spread across the country, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, wholesale, retail sales. So how does real estate do during recessions? Well, we've shown this slide over the course of years in the housing market updates that we do for you. And the numbers don't lie. You know, the recessions do not have to negatively impact the real estate market. The one that did was the one that was created by the housing market, which was the financial crisis in 2008, which we just discussed. But again, if you go back previous housing market updates and you think about that, or you look at the stats, there was a lot more inventory. There was much less demand. It was much more about prices being driven up by loan products, which is very different from where we are today. So, a recession doesn't necessarily equal a housing crisis. That's the bottom line. So I agree with this last quote here. If you were to looking to buy a home, I would still recommend you do so, even at the higher interest rates, because we have no reason to believe that home prices will stop appreciating. I love this here. Home values going up is only a problem when you're trying to buy. When you own, it's a gift. That is so true. So why wait any longer to receive the gifts? Keep persisting on buying your home, because if you're going to stay there for any duration of time, the market will make up for it. Rates are going to change, you refinance, so on and so forth. Okay, so some housekeeping items before we get to our panel. Join us on July 22nd for the next housing market update. You can always stay informed by going to the website hmupdate.com. And thanks to our sponsor, NewOp, the Business Opportunity Exchange. I say this every month: if you're a real estate agent or a mortgage banker and you're not yet a member of NewOp, you're crazy. There's business opportunities being exchanged there every month, and you should check it out. All right, let's go to our panel. I'm just going to go in order of who I see. Carol, you're first, and your name also alphabetically is first, so we'll start with you. What are your just initial reactions to the information that was just conveyed there?
Well, I totally agree that home prices are holding. There is a softening, but on houses that are very appealing, priced right, you still are seeing multiple offers coming in. So it is still active. It's still very active out there. And just not quite the frenzy it was, but still very active.
Still intense.
Yes.
Yeah. Okay. I have some specific questions on the intensity, and I'll ask for both you and Keren. But Keren, go ahead and unmute your mic and give us just your general opinions on the market and the information you just heard.
I definitely agree that buyers have been freaking out, for lack of a better word, with the last increase we've received, and it actually reduced their buying power, because if they could buy a home at $500,000, now it's below. But that is something that I recommend to all my buyers, ones that we have not found a home for yet, to consider and speak to their mortgage lender so that they can give them the exact numbers. Just like Carol said, though, houses that are properly priced and marketed well by the listing agent still get a few offers, maybe not 10 or 15, but certainly 5, 6, 7. So it's still definitely a hard market. The thing is, if your house was overpriced and you were able to sell it, now you can't.
That's a good point. So in other words, what you're saying is, there was a moment of time where almost anything was selling at whatever prices were listed.
Literally anything would sell.
Right. And now buyers are being more conscious. Appraisers, I'm sure, are going to start to get a little bit tougher, as anytime you see a major shift in a marketplace, the appraisals usually tighten up one way or the other.
Right.
Yeah. Okay. That's good to know. And then, are you still, and I want both you ladies to answer this question, are you still seeing people waive inspections and just do them for information purposes only?
For me, it depends on the condition of the house. If the house looks to be fine and in good condition, our buyers are more educated because of all the information that's out there. And obviously, when they work with a realtor that has been working in the market for a while, they know what to look for. And so if in the past we used to say something like it'll come up in inspections, when they ask us, we can say things like we can do inspections, but you can see how well the homeowner takes care of their home. You can tell when a house doesn't have issues. If it smells moldy or there's crack in the foundation, people can see it for themselves. They're a lot more educated than they were a few years ago. But they still are waiving definitely inspections. The appraisals, not so much.
Okay. Carol, are you seeing the same thing?
Yes, I see it more with the appraisals being waived when the mortgage amount is not close to the selling. Like if they're buying the house for 500,000 and the mortgage amount is only 250 or 300, then I see it more. But if the house is 500,000 and they're mortgaging, 450, then I might still see the appraisal.
Yeah, the bank's going to require it in that situation, right? With the loan to value ratio so high, right? Close to 100%. Yeah. Okay. All right. That's good. So let's check in with our mortgage guys because we have a special guest, Scott Ferrell, who Keren Dolan is going to introduce here. So Keren is from AnnieMac Home Mortgage. Welcome, Keren.
Thank you, Geoff, for having us today. And so, admittedly, when you obviously I do business here in the local market, and I've done business with you guys for a long time. And when we're talking about mortgage rates, I want to bring in my backup because as it relates to structuring loans and making sure people close on time and going over all the right programs, I'm your guy. But in all honesty, Scott, who's our a VP of Capital Markets, and what that is every mortgage lender really has a department where they're locking loans. It's a familiar term, but what happens behind the scenes and where loans are either being serviced or sold to, and how interest rates are derived. There's obviously professionals involved in that segment of our industry, and really those guys have computer screens as wallpaper in there, and looking at stuff that would make our brains hurt. So really, for a technical picture, I asked Scott to join us, and I can always give you my feedback on the current market as it relates to programs and so forth. But Scott Ferrell, obviously, I'll pass the baton to you, and Geoff, shoot as hard as questions as you can at him for today because he can answer them.
Scott, I guess, Scott, welcome. Thanks for being here. And in an indirect way, I think Keren might be calling you a geek or a nerd or something like that. I think you should take that as a major compliment, right? Because the geeks and the nerds, they seem to run the world these days,
Pretty much. I'm widely renowned as the worst salesperson in the entire company. That's why they stick me in this situation. So
yeah, but probably the smartest guy in the company. So we're thrilled to have you.
Great. Well, yeah, thank you, Keren. Thank you, Geoff. A lot of great content in all of these slides and the commentary. I agree with pretty much everything. I love the term, deceleration. That's sort of my view of what I see in the housing. I don't see a bubble popping at any point in time. I love the slide that you had on mortgage rates staying relatively flat. I particularly love that slide because it ended on June 2nd, which is also when mortgage rates staying flat ended. We've had a lot of information come out recently from then. Just 2 weeks ago, we've got a red hot CPI print that was higher than expected. The Fed hiked by more than was expected at the time. There's a lot of other things going on as well. So as we sit here today, I think it was 5.09 was the last rate on that sheet. You're in the sixes at this point. We're actually down from a peak of 6.25 earlier this week, and rates just continuing to rise. And certainly the Fed funds rate gets all the headline, right? And but I think everybody underestimates the quantitative tightening that's going on. When the Fed you talk about the $9 trillion that the Fed has on its balance sheet. Now they've stopped new purchases, but we're still reinvesting some of the principals and continuing to buy mortgage-backed securities and treasuries, still keeping rates lower than they would be otherwise. And even as we sit here today, the Fed's still buying roughly 25% of mortgage-backed securities. So the question I ask, and yes, the markets are forward-looking instruments, like I think in that quote from Mike before, they are forward-looking instruments. They have some of that priced in. When the Fed steps out later this year, it's tough to see where that demand comes from. So we might be looking at another, another rate increase, mortgage rate increase, not Fed funds, although that's definitely coming, in the near term. I could certainly see that being a possibility, and what that means to your borrowers. Qualifying for rates becomes a little more challenging. Undoubtedly, you have some borrowers out there that are very cuspy on the conventional side of a debt to income ratio. So you may see some more transactions as the offers start to go down from 5 to 4 to 3 to 2 with FHA transactions that allow for higher qualifications. I think that's going to become a little larger increase in the market share. It kind of fell out of vogue when the demand was high, and now I think you can see a spot where they come back into play. And then the other thing, there are other options out there for borrowers today. If I'm correct, and the near-term outlook is a rise in interest rates. There are programs that allow you to lock in ahead of even finding a home. So lock and shop programs that allow you to lock your loan today, lock your interest rate in, and then go shop for a mortgage. So those are a couple of things that we're doing on our side to help more and more borrowers qualify.
So there's a lot of really good information that you just conveyed there, and I just want to kind of interpret some of it and kind of bring it down to a simple level for people like myself to understand, and you tell me if I got it right. I guess one of the mysteries for me is there had been so much quantitative easing, which essentially is the printing of money, correct? Scott, right?
That's right. Yeah, they were buying mortgages, buying treasury, and sticking it on their balance sheet.
Right.
Creating liquidity.
Right. Creating liquidity so that the economy can keep chugging, so on and so forth. And we had a massive amount of it, unprecedented amount of it because of the pandemic, right?
Correct. Yeah.
So one thing that just baffled me was, things were moving, the economy was rolling, housing market, everything where it needed to be. And yet the federal government brought out yet another pile of cash into the economy that to me was just such an obvious thing that shouldn't have been done, right? And now here we are. Now they're getting so tight and contractionary that it's like, well, why did you do the last one? We could have just weaned off a little bit easier, right? Is that fair to say?
100%. That's been the biggest criticism of the Fed and maybe some of the fiscal policy out there too. The spending. Fed was late to the party and started taking away the punch bowl, right? That's the phrase that gets out there. So they should have been acting sooner. They should have been winding this down sooner, and it would have been a little easier to navigate that soft landing, right? When everybody talks about. And now even with the larger increases in the Fed funds rate that's coming, it's harder and harder to see an outcome where we get that soft landing.
Right, exactly. So now you see these drastic increases in rates. We're already at 6, right? We're 100% increase from where we were 6 months ago. And from what I'm assuming that I'm hearing what you're saying, it ain't over, because now we don't necessarily know how much the Fed is going to absorb of the mortgage-backed securities. And the private sector surely is going to reduce if the Fed is going to reduce, right?
Correct.
That's pretty much how it works.
That's pretty much how it works. The X factor is when rates get to a certain level that attracts more demand, or when inflation starts to come down, then you could start to see a little bit of a rally in bonds. They just become more attractive. Right now, the yield spread compared to inflation is not, why would you want to lock in a long-term bond with inflation's at 8% and you want to lock in 5%?
Right, exactly. So that reason right there that you just said is inflation is the key thing that we're talking about here, because of the differential between the bond rates and the inflation rate, right? So that everybody knows, I'm learning as everybody else is learning here. And this is great to have you here, Scott. So if inflation can get under control, and the way that they're trying to do that is by restricting the supply of money, essentially, right, which causes pain, which is probably going to be a self-inflicted recession. But at least that gets things back into order where bond rates become attractive to the private sector.
Absolutely. I think there will be some normalizations. This is a healthy part of the process, right? You alluded to it before. The recession is part of the cycle, the economic cycle. Coming out of a boom, it's hard not to end up on a bust, right? So this is a healthy, not comfortable, not friendly, no one likes it, but it's a healthy part of the cycle.
Right. But would you not agree, as far as the housing market goes, and this is where we can kind of close the loop and end things, we have what really is driving the price of real estate right now is traditional supply and demand, correct? Right. So I think I lost your mic there, Scott. I don't know if
Sorry, I'm back. I'm not sure if you can hear landscapers in the background. I apologize.
No. So I only hear you, but I think your mic is very directional. So, but anyway, Scott said, yes, that is what's driving price of real estate right now is traditional supply and demand. And again, I keep coming. I didn't have the slide in this month's housing market update. I probably should have, but every so often I show this population curve, right? And the largest population in the US right now, according to Census Bureau data, is people that are buying first-time homes or trading up to bigger homes. So there's a massive amount of people trying to buy a home finally, and that's really what's keeping things kind of in check. So I think as long as people still want to continue to buy a home, I don't think we see a bubble bursting.
No,
oh, sorry, Scott, go ahead. I was just going to add, we still are in, right, six months of less than 6 months of inventory as a seller's market. And we really only have 2 still. And now with the media kind of pushing this interest rate topic, I think just the general public too kind of thinks the Fed's fund rate being increased, that means mortgage rates, so we spent a good amount of time sort of, kind of explaining how those two are not directly correlated. But, still there's a lot of buyers that are spooked out of the market. And so as much as it's a good time to sell, you have less than 6 months of inventory. So you're going to see appreciation, great time to sell a house, right? But it's also still a great time to buy because right now this media is sort of spooking some buyers out and clearly the competition goes down a little bit as well. And so, I always like to tell people, and you had that slide earlier, and this is more real conversations that we have with buyers and borrowers every day is, you can take that if you look at the last year, right, and you see a 6% rate and you go back to the end of last year and you saw a 3% rate, well, that's going to make you feel a little bit upset about maybe you didn't buy at the right time.
Yeah, you missed the boat,
but open
right?
That up, yeah, open it up to where you showed, the 80s before with an average rate in the 12s, right? So the price of money is still cheap. Competition is clearly, there are some people taking a back seat, but but the buyer demand is still there and the seller demand is still there. Overall, a lot of optimism. The recession, if it happens, it'll cool the market down a little bit. Obviously it'll give some confidence back to consumers, I think, and we'll probably end up in a much more healthier time. And I read Chase made an article, and I'll kind of just finalize my statement with this: like a recession is not a depression, right? It's just a short period of time that's going to be natural. It doesn't need we don't need to use that as a phrase of fear or things actually getting worse. I think we have to get a little bit worse to get better. And in our real estate industry right now, there's a lot of optimism for this to be a quick event and hopeful to come out on the other side in a normalized market.
Yeah, no doubt. And at the end of the day, I'll leave it with this. It's important to own your home. And no matter when you're buying, if you're going to stay in that home for an extended period of time, it'll all get worked out in the end. Like if you have a rate of 7% interest right now on a 30-year fixed, and you have to, or 3 months from now, if the rates continue to go up, you'll be able to refi in a few years when they come down. It's just the mortgage industry is geared up to be able to refinance and it'll all work itself out. So owning the home is the most important thing, and it's a great driver of wealth for everybody. So we always need to encourage that. So, all right, I'm out of time. I could sit here and talk with this panel all day long. You guys are great, but I've got to go, and so does everybody else. So what I'm going to do here real quick is just share the contact information of everybody here, who they are, where they're from, so on and so forth. These are really excellent people, all top producers, great professionals who have been in this business a long, long time. I highly recommend, if you're looking to buy or sell some real estate in the state of New Jersey, Keren Gonen, you couldn't find a better person to do it. And Carol Buchanan on the New York side of the border, there are their information. And Kevin Dolan, one of the top producing mortgage lenders in the New York metro area, a superstar guy. So guys, gals, thanks for being here. I appreciate it. Take care.
Thank you. Take care.
Bye, everyone.